Hey guys, Sean here, and today we are going to go through my top 10 rules for buying and stacking physical gold. Now, gold has been used as money for thousands of years, and today it is one of the few investment classes that everyone from my grandma to billion-dollar hedge funds and central banks are buying up furiously. Now, since 1971, the price of gold has risen from $35 to over $1,800 an ounce, and it is one of the time-tested inflation hedge that everyone should consider having in their portfolio. However, the biggest challenge of stacking gold is not in its high price tag, but getting the right information to make sure that you buy the right type of gold at the best value and with the right approach to stacking it for long-term success. And in this video, I will take you through everything you need to know to buy physical gold the smart and safe way. Now, if you want more gold and silver related content, be sure to subscribe to my channel. It helps me grow and I really appreciate your support, guys. Let's dive right in. Now, the first rule I have is to buy only investment grade gold. There are many types of gold out there in the market and they are all not created equally. For example, this gold Cuban link chain over here, it is made up of 22 karat gold, while this gold kangaroo coin over here is made up of 24 karat gold. Now, which should you choose? As a physical gold investor or stacker, especially if you're a beginner, what you want to do is to focus on getting investment grade gold. But what is investment grade gold? Now, it is gold that is 99.5% pure, bears a mark that guarantees its purity, and can be traded easily on the international bullion market. So let's take this gold kangaroo for example. It is a 99.99% gold coin that is produced by Australia's Perth Mint and is internationally recognized and can be easily bought and sold. Now, if you look carefully, you can see over here there's the P mark that symbolizes the Perth Mint, as well as the purity details over here. And when you turn to the reverse, you can see the coin's face value of $100. Now, understanding this is important because you don't want to pay additional taxes on your gold purchases if you don't need to. Depending on your country, there might be taxes on your gold coin purchase if it isn't investment grade. Now, in Singapore, because this coin is considered investment grade gold, I don't need to pay any sales tax on it. For some countries like the United States, the gold eagle over here is considered investment grade gold, even though it is 22 karat gold and not 24 karat gold. So 22 karat gold basically means that it is not pure gold, it's only 91.6% gold, and the rest is a mixture of other metals like copper or silver to make it more durable. But at the end of the day, you're still gonna get 1 ounce of fine gold in this gold coin. This means that the Cuban link chain over here, it's not considered investment grade gold. It is considered a piece of jewelry. It is meant for wearing and decorative purposes and not to be traded in the open market. That means that when I bought this gold Cuban link chain, I had to pay sales tax on it, and there's also a craftsmanship cost to it that will jack up the price by quite a bit, anywhere from 15 to 30% more. And you definitely don't want that if you're looking to purely stack gold. So go after investment grade gold such as the Australian kangaroo, the UK Britannia, as well as the Canadian maple. All these are great choices for investment grade gold. Now, bars such as this Credit Suisse gold bar, they are also a great investment option and is also considered investment grade gold. You can clearly see its purity stamped on it, as well as the refiner's mark over here that guarantees its purity, allowing it to be traded in the market, right? So at the end of the day, you want to ensure that you buy highly recognized gold while paying as close as possible to the spot price. Which brings me to rule number 2, right? Always try to pay the lowest premium possible on your physical gold purchase. Now, here's the truth about buying physical gold. Every stacker knows it, and I'm just gonna say it. Unless you are lucky and you get to buy your physical gold at spot price, you will lose some money up front because you will have to pay what is known as the physical premium. So if you're unaware, the physical premium is essentially the cost to mine gold out of the ground, refine it and mint it into a bar or a coin that you can physically hold. And depending on the type and size of the gold that you buy, you might have to pay more or less of a premium. Now, one rule I personally follow is to buy gold bars or coins that are 1 ounce and above. And that's because of the physical premium will be quite considerably lower compared to smaller coins, especially those that are a 1/4 ounce or 1/10 of an ounce. Now, for example, this 1 ounce gold maple has a premium of around 4 to 5%, but a 1/4 ounce maple's premium will be around 17%. Yep, this is the maple. And if we get down to the 1/10 ounce, the premium gets more ridiculous and can even go beyond 30%. So for example, if you were to get a 100-gram bar, the premium will drop to only around 2 to 3% because it's a heavier bar, it's heavier than a 1 ounce coin. But if you have enough money to get yourself a 1 kg bar, which I think is around anywhere from 50 to 60,000 US dollars, the premium, you can expect the premium to drop to 1% or even lower. Now, I really want us to maximize our dollars and get the most gold possible, but I do understand that gold is expensive, especially if you're starting out. And sometimes all we can afford at the moment are smaller fractional coins, and I do have a bit of smaller coins as well when I first started stacking years back. Now, I personally believe that fractional coins are still viable, especially when it comes to help you establish a physical position if you have none and when your budget isn't really full enough for a complete 1 ounce coin. Now, if you really want to pay the least premium possible, then you can consider gold bars instead of coins, right? They are usually cheaper than coins, but not really by much. Secondly, guys, we need to talk about numismatic coins, right? So when you shop for gold, especially at local coin shops or even some bullion dealers, sometimes you might encounter semi-rare collectible coins such as the St. Gaudens Double Eagle or the British Gold Sovereigns, right? These are not investment grade gold that you should buy if you're stacking physical gold. They cost more than bullion gold due to their rarity and historical value, and unless you're a gold coin collector and have spent years dealing with them, you really just want to avoid them for now. Not only will they have a big premium upfront, it is going to be a nightmare when it comes time to sell them if you want to recover the premium or even make money on them, right? You have to find a buyer who will want the exact same coin that you have, and if you can't find any and if you need the cash urgently, you might be forced to sell it off at spot price that's going to cost you quite a bit of cash. So just stick to the regular gold bullion and avoid numismatics, especially if you're stacking out. Now, rule number 3, dollar cost average your purchases, guys. Now, whether you are buying gold, stocks, or even Bitcoin, there is a tendency to chase prices up. It's human nature, when we see prices suddenly go up, we kind of enter this state of being afraid of missing out, and that's very detrimental. If the price suddenly crashes, it can be disastrous for our own psyche. We suffer big losses and we are spooked out from ever buying gold again. Now, the gold market is not going to be a smooth ride, guys. It's an investment class that not just retail investors like you and me are buying or selling small bars like this, but entire countries and institutions are actually moving millions of kg or thousands of tons of gold in a single day. That means there could be big upswings or downswings. And when we dollar cost average our purchases, we are spending the same number of dollars every month to buy gold, no matter what the price is at that point of time. This way, when the price is lower, you get to buy more gold, and when the prices are higher, you buy less. Now, the main reason why I personally follow this strategy is because I get to build my position over time without panicking or getting too happy. You really want to keep your emotions emotions in check, guys. With the dollar cost averaging method, you get to build discipline, and it becomes a routine like setting money aside for a rainy day. And the truth is that no one can really predict how gold prices will change in the future, and at least with this method, you'll be able to establish a position in the metal, especially if you are starting from scratch. Now, rule number 4. This is something that is rarely talked about, but I believe is very important. Do not buy gold on debt. Now, I get it. Gold looks shiny. It looks very beautiful, and it's a great investment class that's been around for thousands of years and probably thousands of years more to come. However, no investment on this planet or asset class is guaranteed to perform all the time. Now, I'm not going to say that gold will crash to zero, given the current economic climate of money printing, globally poor fiscal policies. It's highly unlikely, and I personally believe the price of gold will rise in the long run. But there will be times where the price of gold will be stagnant, such as the period between 2014 and 2018, or the price of gold might suddenly drop when it fell quite a bit from its peak in 2011 from over $2,000 to a low of around $1,250, right? However, what is guaranteed is the interest you have to pay on your borrowed money, and you have to pay that month after month or year after year, and that could accumulate to quite a bit of a loss if the gold market doesn't really perform for that period of time. So really, only spend what you can afford to lose, and don't buy gold on debt. Now, going on to the next rule number 5, and this is quite a critical one as well. Only buy your gold from reputable dealers or institutions. Now, there are many ways you can buy gold, guys. You can head down to your nearest pawn shop, or you can buy it from eBay. And I don't really recommend those two for a few reasons, right? Firstly, you want to ensure that the gold that you're buying is 100% authentic, and any credible bullion dealer that's licensed will test the gold that they are selling you beforehand and really stand behind their products. Now, there are many convincing fakes around, and a lot of them tend to be sold on eBay, right? And while I believe also that, pawn shops do test the gold that they resell to you, they usually slap on a markup that can be anywhere from 10%, 20%, or even 30% on top of what the gold's actually worth. And you don't really want that. Now, the safest and cheapest way to stack your gold is from reputable bullion dealers in your own city, or online dealers that have a great track record, right? A great dealer will really make all the difference, and I personally buy my own gold from local bullion dealers and UOB Bank in Singapore, as well as some online dealers such as SD Bullion and AppMax, right? I'm going to leave a link to some of the online bullion dealers in the description below. And if you have the chance, right, I really prefer it if you can actually head down to your local coin shop or your bullion dealer and get to know the people them personally, right? They will help guide you through the process of selecting and buying your gold, and even educate you on the different types of bars and coins you can get for your budget, right? It will be more tailored than what I'm actually relaying to you right now in this video. They will know the budget that you're working with, and they can actually give you good recommendations, right? And best of all, if you get to know them personally, they might even inform you when they have a shipment of coins or bars coming in that you really want. Now, for rule number 6, what you want to do is to always test your gold bars or coins before you buy them. Now, the thing about gold is that it is really expensive, especially when you get to the bigger bars, right? So for example, this 100 grams of gold, this 100-gram gold bar is around $6,000, and I'll be really upset if it turns out to be a fake. It's not a fake, I had it tested out, but hypothetically speaking, right? Now, there are two ways to test your gold: the traditional or the modern way. Now, the old way is simply to measure the dimensions of your gold bar or your gold coin, and check if it matches the official specifications published by the refiner. Now, every bar or coin has a certain length or diameter, as well as a thickness that's unique to the type of bullion that it is. You can then double check its weight with a little scale, and a 1 ounce pure gold coin or a bar should have no less than 31.1 grams. And if both these physical checks work, then chances are you have a legit coin or a bar. However, it is not foolproof, and I'll tell you why. There are fake gold bars floating around that have a tungsten core and are coated with a thin layer of gold that's really very problematic. The thing about tungsten is that it has the almost exact same density as gold, and that means it can easily pass the dimensions and the weight test that we went through earlier. We kind of need a better test, right? So thankfully, most bullion dealers that you buy from should have this device called the Sigma Metallytics Precious Metals Verifier. Basically, when you use this, you can check if the coin or bar is really made up of pure gold or not. Essentially, it uses electromagnetic waves that penetrate the surface to test if the entire coin or bar is truly gold or if there's something else mixed with it and it's not authentic. Now, I really recommend requesting this check if you're buying from a local coin shop or bullion dealer. If they are really legit, if they are really legitimate, they will have nothing to hide and will be more than happy to do it for you. Remember, the last thing you want to do is to be spending thousands of dollars on what could be a fake. And rule number 7. I want us to really find a secure place to store our physical gold. Now, gold is portable wealth. It doesn't tarnish and holds a tremendous amount of value in such a small size. But it is exactly because of this that if anything happens to it, you can suddenly lose quite a bit of wealth. That's why I recommend taking the necessary precautions to secure your gold, whether you're looking to store it at home or at third-party vaults. For myself, most of my gold is stored in private vaults or safety deposit boxes, and for the few pieces that I keep around to make videos such as this, it is in a safe that's drilled into the wall. I think the basic rule of investing in gold is firstly to never talk about it, and if you really need to tell someone just in case, make sure they're really close family members or friends that you trust. And depending on where you're from, you might need extra levels of protection. So I live in Singapore. It's one of the safest countries in the world, but I don't want to take any chances as well. I've heard methods such as storing your gold in a treasure chest, taking a hike into the woods and burying it somewhere deep in the forest and marking it on the treasure map. But honestly guys, that's a little unrealistic and near impossible if you're like me living in the city, right? Besides, if someone else comes across your gold, if you hike into the forest and you bury under a tree or log, you've practically lost it forever. Good luck trying to prove that the gold is yours, and the person who most probably got your gold, you'll be keeping it quiet, hiding it in their home or somewhere. So I personally believe in storing your gold, especially when your stack grows, in a private vault. And the great thing about private vault versus bank vaults is that it is outside of the financial system, and if anything happens to the banks or if they are just simply closed for the day, you'll still be able to retrieve your gold when you need it, especially in times of crisis. Just be sure to make sure that your private vault allows you to inspect your gold at any time that you wish, even in the middle of the night or during holidays. Has top-notch security. I'm talking about CCTV, security guards, big steel vault doors and walls that will make it even difficult for James Bond or Ethan Hunt to break in. You also want your vault to provide you with some insurance coverage for your gold, so if anything happens to them, whether if the building collapses or somehow they mysteriously vanish, you'll be compensated at the end of the day. Now for rule number 8, this might be a little controversial, but bear with me. Now the truth is that not everyone will be able to invest in physical gold, and that is why my rule number 8 is to consider gold ETFs. Now maybe it's because buying physical is really inconvenient for you. You just don't trust the online dealers. You're living miles away from any physical bullion dealers or coin shops, or maybe you're just living in a really shady neighborhood. Now, don't get me wrong guys, I am and I will always be a physical gold supporter first, but I get it. Not everyone has the opportunity to buy physical, and it's going to be a real shame if you can't get exposure to gold. That's why I think that you should take a look at a few gold ETFs if you really can't get physical, and this includes the SPDR Gold Shares GLD or the iShares Gold Trust IAU. Now, gold ETFs are simply exchange traded funds where you invest in a fund that tracks the price of gold, and they hold physical gold to back it up as well. So if the price of gold rises, you make a profit. If the price of gold falls, you lose money. Simple enough. And you can simply buy them off trading apps like Robinhood or through your own stockbroker or online broker, right? So the great thing about ETFs is that the annual expense ratio, which is the management fee of the ETF, is only around 0.3 to 0.4%, which is much less than a physical premium for the physical gold or coin. You lose less money upfront when you buy ETFs, which means your profit margin technically will be higher when you sell. All that being said, however, I still believe that if you do have the chance to buy physical gold and store it well, you should do so. While buying ETFs do give you exposure to the price of gold, it is still within the financial system and does hold counterparty risk. Remember, when you invest in an ETF, you don't physically own the gold. You have a paper claim to the gold. However, it is not in your physical possession. You don't hold the gold like how I'm holding on to this gold bar right now. And in the event, if the fund doesn't have the physical gold to back it up, or somehow they lose money due to bad practices, they start dabbling in derivatives, you could really see the physical price of gold fly up, but the ETF's price might stay stagnant or even fall. So unless you're a short-term trader, I really recommend buying the physical bullion before considering ETFs. Only treat it as a last resort when you don't really have any other chances to do it. Now, rule number 9, have a diversified portfolio. Guys, I love gold, but that doesn't mean all my money is vested into it. I would think it would be rather dangerous and quite foolhardy if you invest every single dollar that you have on hand into gold. We all know that gold helps us to hedge against inflation, and it has protected purchasing powers for hundreds and thousands of years. In fact, it's even said that a single ounce of gold back in the ancient days could have brought a toga for a Roman senator, which is basically a full set of clothes. And today, the same ounce of gold can buy you a decent suit at a tailor's, right? A full gentleman's suit. And that's unsurprising. A single ounce of gold today is around $1,800, and that can really get you a nice fine piece of suit. However, right, I have to state that gold doesn't pay dividends. It is simply a piece of metal that sits around until you sell it off for capital gains. Your gold bar or coin won't suddenly give birth to another piece of gold. It doesn't happen, and conventional wisdom states that you should own around 5 to 10% of your portfolio in gold. While I've done some digging around, I found research from Mike Maloney's goldsilver.com. They have done quite a fair bit of their own analysis, claiming that 20% is the sweet spot between risk and return, and I'll leave a link to the article below that you can check out and really read for yourself and make your own decisions. It kind of really depends on your own personal situation, risk tolerance, and how much money you have to invest. But there are really other asset classes that you should be aware of. That includes farmland, real estate, and the S&P 500 as well. Now, the thing about gold is that while money printing will eventually drive the price of gold up, there will be times where the price might stay flat, especially when the economy is doing well. Yes, over the last 20 years, gold has risen from $260 all the way to $1,800. That's nearly a 600% gain. And if we were to look at the S&P 500 on the same period, we can see that it has increased around 1,000 points to over 4,500. That's around a 350% gain. Now, it sounds awesome, right? But you gotta understand that between 2013 and 2018, for 5 years, gold's price movement was essentially as active as a zombie. This was because our economy was slowly improving and interest rates were climbing. But during that same period, the S&P 500 saw an 80% gain when gold didn't move much. And that is really the power of diversification. When the economy improves, you'll be able to gain more when you're in stocks in times of crisis, and when there's a lot of inflation going on. Gold will outperform as well as be there for you as a safe haven asset. I do believe that with all the money printing in the world and with big countries like China and Russia furiously buying gold, it will eventually rise in value over time. But it won't be a smooth ride, and there could be years where its performance might be rather lackluster. And that brings me to the final rule that I have. Rule number 10. When you buy gold, you are investing for the long term. And when I say long term, I don't mean a couple of months or even a year or two. I mean ultra long term. The trouble with many people today, myself included in certain circumstances, is that we think with an instant gratification mindset. If we don't see a 10% gain in a month, we feel uneasy. And the rise of Bitcoin isn't really helping the situation either. If you buy physical gold today and suddenly sell it tomorrow, I can almost guarantee that you will lose money because you will lose the physical premium that you paid for. I really want us to sit back and understand that gold is a long-term journey. Stacking it is a long-term journey and truly a way of life. It is how we will secure and protect our wealth for decades and generations to come. Gold is something that you can leave to your children and grandchildren. It is an asset that will hold on to its value when you are long gone. And I don't really think we can say that about many other asset classes, right? There's a quote that I heard that is worth repeating. Companies come and go, nations will rise and crumble, but gold will last forever. So there you have it, guys. My top 10 rules that you should keep in mind when you're stacking physical gold. I want it to be a fun and safe experience for you all, and I hope this video has made it easier for you to get started. What do you think about the rules? Do you think there's anything that I should have added on, anything that I missed out? So if you have any questions or opinions, let me know in the comments below, guys. I really love to hear from you all, and if you enjoyed today's video, be sure to smash that like button and subscribe for more gold and silver videos. Thank you guys for watching, and I'll see you soon.